Hello and welcome again to another webinar here to give you an update as to where we're at in the current market conditions and kind of answer some of the questions that we've been receiving throughout the week. And as it has been for the past few weeks, things continue to change fairly rapidly, although we've had a little bit of less volatility in the markets over the last several days. Certainly, the economic data is continuing to not look positive, which we had expected. We are now over 26 million that's unemployed, which is a 15% unemployment number. And so we expect that to continue to go up as we are at some point going to try to open the economy again. Oil was a big topic this week, and so we're going to address that in the webinar today. But before we do that, I want to have a little fun and make sure that we lighten it up on a Friday afternoon. So I've got a couple poll questions. So what you can do is you can look at your screen if you're on a mobile device and you're following on the computer. Thank you. If you're calling in today, unfortunately, you're not going to be able to see the questions. Or if you're following us on Facebook, thank you for that. And you can hit share and share us around on this great information. So question number one is, who was president last time oil was under $10? So you can submit your question now for question number one. I'm going to give you a couple seconds to submit it. Go ahead and submit your question. Okay. When did the Dow close on April 26, 2015? And the last question is, be fearful when others are greedy and be greedy when others are fearful. Who said that? Dave Ramsey, Jim Cramer from CNBC, or Warren Buffett? Wait, we got good results coming in here. It's rolling in. It's kind of close. You never know when you might get a prize, so go ahead and submit. All right, so the first question. Who was president when the last time oil was under $10? And it is a close first and second. 41% said John F. Kennedy, but 53% said Ronald Reagan. And Ronald Reagan is the right answer. It was actually in 1986. 1986 is when it was under $10. Where did the Dow close on April 26, 2015? So literally almost to the day 5 years ago. So many of you, 47% said 17,934. Followed closely by 41% said 14,545, and then 22,000. The correct answer is 17,934, and today we're almost in the range of 23,600 to 24,000. So if you think about it, 5 years ago, 17,000, and I know many at that time thought that it couldn't get to 20 or 22, and here we are still at over 23,000. And then the last one, be fearful when others are greedy and be greedy when others are fearful. I said that this one would probably be the easiest. We had 12% answer Jim Cramer. So maybe you're a Jim Cramer fan, so that's good. But the answer is Warren Buffett. And it's interesting about Warren because, you know, many people track his movements and what Berkshire Hathaway does. And he's kind of been incognito and not saying a whole lot. You know, he tends to time markets pretty well, and he's not been saying a whole lot. Although he's had some medical issues in the past and so forth, and they think maybe he's just practicing social distancing. So, all right, so we'll move on. So again, joining me today from their homes is Beth Foley up in Royal Oak from our office there, Bill Davis and Matt Aurenz. And so thanks to all of them. And so our topics today, our three topics are going to be, so we want to talk about oil prices and where we're at from as it stands. Oil prices, we're going to talk about the relief package a bit. There was just another one signed that just got signed last night. and then we're going to talk about cash, and talk. We've got a couple things around cash that we want to talk about. So oil prices. If you follow the market or not, you know that oil prices are probably down. You're probably not filling up your car like you normally would, so, but it's been cheap at the pump, and it's been certainly a discussion this week. So, Matt, why don't you lead us off by just let's talk about oil prices and what happened on a high level and kind of where we see it moving forward.
Sure. Oil, obviously, as many people know, actually went negative for the first time, traded negative for the first time ever. And that was primarily due to several reasons. The biggest one being, well, first let me back up. The first thing that pushes oil prices down at this point is really kind of two-pronged: supply and demand, which obviously demand is exceptionally low right now. And there's a massive amount of supply because cruise lines, airlines, cars, everybody who's out and about using fuel is not using fuel. So there's just an oversupply. And then you have really just a market share that OPEC, Russia, the United States are the three big players, and OPEC and Russia are really just pumping away, harvesting tons of oil to put some people out of business in this time. Primarily, those are state-run, government-owned oil, which the U.S. doesn't have. So they can just keep pumping. They don't really have a concern. In the U.S., you're really not even breaking even pumping oil until it's around $20 a barrel. So a lot of smaller places are shutting down. It's not worth it. But the cost to shut down and restart up also isn't good for them on drilling. So that's been an issue. And then what you had was May contracts came due, or were coming due on the actual options. And the big problem there is, as passive investing has become pretty significant with the forms of ETFs. USO, which is a very large ETF that deals in futures contracts, just passively watching oil, owned a lot of those contracts. And with demand down the way it is, it basically was trying to sell their contracts because the ETF is passive, so it can't actually claim the futures contract. Right? So like if you imagine, where are they going to put all this oil? They can't just dump it on the front door of your business. And so, and there's nowhere to store it. And so they basically had to unload these contracts. So essentially what they're doing is paying people, which is why it went negative. They were paying people to take their oil contracts off their hands and still receive the oil. So that's kind of the issue that happened here in May, which pushed those prices down. We see the rebound, which comes up because it's a forward-looking for June contracts. And so June contracts are actually around $17 a barrel right now. So it has really, again, nothing to do with May anymore. So when you see that recovery in oil, it's not necessarily a true recovery in the price long-term of what consumers are paying, but it's just what the going rate is for a June contract. So that was the big problem with oil this week. And, we'll probably see some more volatility there June, July, until we see an economy that is back out and about and not in lockdown to use oil reserves. Because there's
you think about that, on what you're saying, Matt, is with very little travel, obviously, very little, a few flights, all of that consumes oil. And, Beth, our understanding, we're not oil experts, but our understanding is it's an expensive operation. You just can't shut it down and then restart it. So that's the reason for that pumping of it, right?
Yeah, we talk about that. And I agree with Matt completely. We can just go back in the news and look over the past month or so. Saudi Arabia and Russia kind of dueling it out with each other of who can pump out the most oil to bring that share price down or per barrel. So we've got all of this supply and no demand for it. So, and you can't just shut this down. I mean, I'm no expert by any means, even close, just have read some things here and there, but it's a complex process to to answer the question, well, if we've got so much oil out there, why don't we just stop pumping it? There isn't an on-off lever. Just flip. And as expensive as it may be to turn it off, it might be even more expensive and more complicated to get it up and running again. So that the only logical answer to the experts who do know is to slow it down, but keep it pumping. So I have a question for Matt. Can I toss this out there?
Sure.
Because you are, as of today, our oil expert. What do you think about airlines and cruise lines locking in at cheap prices for oil, so that what might that do for our travel costs and so forth when people do start traveling again? Do you think this is going to be in the long term? Could we see beneficial results of these cheap prices?
Well, if you look back at Southwest, for example, that's the reason Southwest has been so profitable long term. Twofold. Well, there's a lot more reasons. They use the same airlines, the same airplane in all of their models, right? They've kind of streamlined their process, but a significant portion of their profitability over the years was because years ago they locked in tons of oil future contracts, which kept their overhead costs down. I do think that you'll see people do that. The problem is airlines and cruise lines don't have any cash.
Right.
So it comes down to the balancing approach of how do you buy stuff without funding or without revenue. And I don't think that the government is really going to be too keen on bailing them out and them buying oil future contracts at this point. But I have heard some airlines already, purchasing some. I know Allegiant has looked at buying some, and that was before we even saw this collapse. So I definitely think it is something they are looking at. Whether or not they can afford it is another discussion.
Yeah, and I think about they just don't know when things will be back to, it won't even be back to normal for a long time. And so to try to, I'm sure they're looking at, well, this is a great opportunity, but on the other hand, it's not a financial decision. It's more about the health decision and kind of how things get back, kind of somewhat back on track. And one of the things I think about with oil is that, and we've talked about this as a team, this was going to be a discussion prior to this whole pandemic. I mean, it was going on, and then it kind of got pushed aside. And then I think, obviously, with people not traveling and stuff, Bill, don't you think, then it just kind of, now it's come up and it's just kind of rolled in and it got to negative numbers. But we thought there was going to be some issues even before this pandemic started.
Well, yeah, the supply demand had just gotten out of whack, and you got people paying freighters, ships, transport ships, to just sit out in the ocean with full of oil. It's kind of crazy. And this we forget that this happened, in 2008. When you look back at the charts on oil prices, we went from $150 a barrel to 50 in a short amount of time. And in 2015, we went from 100 to 50, and now we went from 60 to 0. Really 60 to 17. And but no, you're right. It was coming. The supply demand is out of whack, and the situation with the Saudis and the Russians was compounded the problem. And it's going to be a while till we are able to get back to our production here in the United States at these kinds of prices.
Yeah, that's a great point. I want to move on, but Beth, you got a great analogy about the storage of oil, and I know I've had some questions this week about how can it be negative. So you might want to share that analogy.
Totally simplify everything that Matt just said, but I was trying to think of, the best way to explain it. The only thing that I could come up with is, let's say that, your cousin or your buddy or somebody just gifted you a beautiful pool table because you're moving into a new home and you can't fit it in the old home. So now you've got to pay a storage unit to hold on to this thing, before you can use it. So it's you've got this asset that you can't use right now. Like, you can't use all of this supply of oil, but it may have been free, but now you've got to pay somebody to hang it onto it for you. So the price of light crude per barrel might be $16 or $17 per share, but if you've got to, or per barrel, but if you've got to pay somebody $50 to store it for you, that's how you run into negative prices. It's a net.
Yeah, it's a great way to simplify it. Thanks, Beth. So let's move on to point number 2 today. So the latest relief package, it is added, one of many, and we don't think that we're really over with this. In fact, I heard a statement this week that I shared with the team in a meeting earlier, but that the market is really divorced from reality on Main Street at this point. That what's happening on Main Street and what the markets are doing. I know there's many that are perplexed, but I think there's definitely needed things within this relief package that got added on. And so, Bill, maybe you just give our viewing audience, listening audience, the highlights.
Yeah, absolutely. Yeah, the president just signed it a few hours ago. So it was bipartisan. They got it done. There was a lot of pushing and shoving as usual, but 320 billion of the 484 billion, so almost 490 billion is this one. That will be for the Pension Protection Act replenishment. I'm sorry, payroll protection loans. They did carve out of that 320 billion about 60 billion to try to push it to smaller businesses by limiting those dollars going to credit unions and smaller banks. So they thought that by making sure 60 billion went to the smaller regional banks, that would get to more of the small business loans. They did put in just about 100 billion into healthcare, and part of that, about 25% of that, or 25 billion, was allocated for coronavirus testing. And so that hopefully we can get all of this testing up and running more aggressively than we have right now, because I do believe that's really going to be the key to getting the economy going. And there is no additional stimulus checks, so don't be looking at your bank. Not all the stimulus checks have even come out yet, but that first PPP was they lent a record 1.7 million loans, and I think that was more than they have written in 15 years.
Yeah, in a very short period of time.
Yeah.
Yeah. I have a couple of clients who work for banks and work in the lending parts of banks, and just talking to them, they are working 7 days a week, 11, 12 hours a day to try to keep up or even catch up with all of the paperwork and all the loans. They're just totally overwhelmed with writing these things. So, it's nice that more money is there, and there are people working really hard to get it out to the people who need it.
Yeah. And we call this relief package, and it was part of CARES Act, and there's kind of different terminologies, but Matt, we do think this is just relief. This is not stimulus, really. This is just to try to maintain what we can in our economy.
I think so. I mean, relief, stimulus, it's difficult to tell which is which at this point. I think the reality is they're just trying to determine how do you keep businesses from failing. Keeping people at work is one thing, keeping businesses from failing and prolonging people not, furloughing and being able to get back to work is a huge component. But if you don't have anywhere to go back to because all the businesses have gone belly up, that's the bigger issue, I think. And so the biggest thing that we've seen obstacle wise is what happens when this money runs out for some of these businesses. Are they going to come back and keep their doors open, or are they going to come back and file bankruptcy? How long does this keep them afloat? And I think that is a looming concern that we're hearing more about. Bill, I think you were talking about that just a little earlier today. So maybe you have a comment there.
Well, yeah, I mean, if we can't get the economy running again, and we can't figure out how to get people back out into these businesses, I think we're going to be challenged with those, saving these companies, and now they're going to be sitting on a big loan that's not forgivable if they don't keep the employees.
Yeah, I think and that's the real challenge here. They're talking about opening up back parts of it. And, we're all glad we're not a part of that decision, because that's a big decision. And, but now we're starting to see some major layoffs of companies because they were able to kind of go for this period of time. I also saw today from one of the folks we follow, particularly in retail, that they expect maybe 30 to 40% of the malls to not be in existence. Some of those stores were challenged anyway, but you can imagine people conglomerating back into malls and large, kind of large groups. So, so that's the reality we're talking about. We don't really know on the market, do we? Where it's at? Are we at the low? We've evened off a little bit on volatility, but no one knows for sure. And we do know almost for sure, don't we, Beth, that the second quarter results, when we get into the next quarter, are not going to be look good.
Yeah, because the second quarter is going to reflect these, 26 million people who are not working, people not spending money. The second quarter numbers are just going to be bad, is the only way I see it. And that's going to have a psychological effect, but it also accurately reflects the business aspects of it. So when we get to late June, early July, as the numbers start coming in, just, be prepared that they're going to be some of the worst that by far that we've ever seen with that. And that's going to hold true even as, the economy starts slowly opening up again. I mean, we're all the way through April with numbers down, and if the economy and people getting back to work dials up slowly and carefully and pragmatically, it's not going to be enough to overcome some of these negative numbers. And what we've been talking about with Matt's guidance is, the second quarter is going to look bad. Hopefully, depending upon what happens with regard to vaccines, therapeutic treatments, sheltering, social distancing, that maybe the third quarter might look a little bit better, maybe a little bit better into the fourth quarter. But we're in for a long haul of recovery.
Yeah, thanks.
Hey, Matt, hey, Erik, if I can make a comment about, because a lot of people are going to be hearing companies reporting their profits. And of course, they're going to be hearing a lot of bad news from profits. But in those same reports, we're starting to see the strength of balance sheets. So there's a lot of companies that have strong balance sheets that, even though their burn rate's pretty fast on their cash, they're kind of rising to the surface. We've been talking about this for the last 10 years when companies have been making record profits. Those that were smart, that built their cash reserves, that improved their balance sheet, they're really rising to the surface now. So that's why I think we get some of these spikes, and that we will get back to a stock market normal when the economy starts to come out of the coronavirus.
Yeah.
Well, I think it's a great point. I think the other thing is we don't know how much of this is already priced into the stock market. And that's the real difficulty that I'm seeing right now is, the first quarter earnings come out, they don't look too bad. While you had, of the 3 months, you had 2.75 of it was first quarter when it was still booming. And so, we don't know how much a 6 to 8 week halt in the economy is really gonna hurt things. And it's not gonna hurt every part of the economy. But again, when you have when you got somebody like a Disney or, just name a company down 40, 50%, it's just like, how much of that is actual overselling that is unrealistic? That if you have a second quarter that's really bad, we don't know. Does that merit a stock going down even further, or does that all of a sudden say, oh, that stock was oversold? It's actually should be priced at this. And so even though earnings come out at a poor, it was so oversold that the value actually needs to increase to be fair market value. So I think we'll see a combination of both of those. The question becomes is how long does that last? Because the second quarter is one thing, but if that bleeds into the third and fourth, to Beth's point, that's bad. But I think we'll see that recovery part. Again, I'm pretty optimistic and hopeful that this isn't going to be a 6 to 8 month thing.
Yeah, well, and I think those are all great points, and a couple positives, and then we'll move on. Is that I think about is, and I've heard this. Number one is, if this would have happened prior to back even 10 years ago. I mean, we're fortunate enough there are a lot of companies that are still functional because of technology and being able to work remotely. And I know if this would have happened 10 years ago, just us in working with all the clients on the webinar today, it would have just been more challenging because we have just so much better technology. Secondly, is we have the best and smartest scientists and doctors in the world working on this in rapid form. And so those are positives to kind of take from that. We will get through it. It will come through it. So we will move on to cash. And so if I had to put this up before the little quiz, maybe you would have thought there would have been some cash, but we just wanted to talk about cash, and you may be sitting on cash, or maybe just thinking about I've got some cash, or how much cash should I have? So let's make some comments on that. Bill, you want to start maybe?
Sure, and I think part of the reason we added this to the list is because it's been a common question, both stimulus money that's come in that people don't need right now, and what do we do with it? And others that just have accumulated excess cash in low yielding positions. And I'm starting to hear questions like, hey, should I use a fixed product, a fixed annuity, a certificate of deposit? And my concern continues to be liquidity with those products. And so I'm just not a supporter of not being liquid during uncertain times. So there are higher yielding products that are liquid that you could talk with your advisor about, but certainly I wouldn't be buying into any 2-year, 3-year, 5-year types of products. That would be my concern, because we are seeing money flows increasing in those kinds of products.
Yeah, and I'm sure everybody here, if you have it, you're going to get email, you're going to get mail, you're going to get postcards, and all what Bill you mentioned that shows a base rate and a bonus, and it's going to look good. And but you need to talk to us if you want something like that. We have that in our toolbox. That we know that we're not commissioned, so we don't. Those are typically commission based. They have them available if you absolutely want one, or you want to discuss it at least. But we're just saying, don't make the short-term decision based on emotion. Make it on long-term. And so we had a question that came in about cash, and if someone's in good shape right now and they receive the stimulus check, should they pay down debt? Should they invest it? What should they do? I'll just start off by saying, if you're in good shape and maybe you want to at least contribute a little bit to one of your nonprofits, you can do that. $300 charitable contribution this year. It came part of the CARES Act and come off your taxes. So that might be a place. But Beth, maybe we got a couple other choices that.
Yeah, absolutely. And this is all of us putting our CFP hats on and being financial advisors first and foremost. Whether you pay down debt or make an investment, that either one of those acts helps your bottom line and helps to grow the net worth if the investment works well. So I think this is one of those situations where maybe it's a little bit of both. I frankly just did this personally. I had a little bit of debt and I just took care of it because, the money was there to do it. But we always want to make sure that you have sufficient reserves, right? So, in this question, our client who asked the question said, I am in good shape. I have the reserve. So first and foremost, making sure that your cash reserves are sufficient. Is it 3 to 6 months worth of household expenses, 6 to 12 months? What's your comfort level? If you are somebody in retirement and drawing money from your investments, do you have a good amount of money in cash so that you can sustain those distributions without having to sell anything in the portfolio for an extended period of time? I would look at your interest rates on the debt that you are considering. If you're sitting with a car loan at 0% interest, so you're using somebody else's money, or student loans, right? Remember, as part of the CARES Act, 0% on student loans, that to consider what the interest rate is with the student loans. Remember, at 0%, anything you put toward that goes right toward principal from now until September. So, to what Bill was talking about earlier with us before the call, it's like 50-50. Why not do a little bit of both? Because it does help your bottom line as far as growing your net worth. And I think there's room in there with the extra cash a little bit to, maybe it's time to start feeding a little bit of money into the markets. If, having a conversation with your advisor and knowing what your risk tolerance is, that, to Matt's point, maybe some things are a little bit oversold and there's some attractive prices out there to consider and talk about. We're not by any means saying it is time to, rebalance, go all in, but, maybe with a little bit of extra cash, there's some opportunistic investing that you might consider too.
Yeah, so let's expand on that a little bit, because maybe, we have, you're at a position where you've got your cash reserves, or there is money set up, and I know how we manage our clients. If you're taking distribution, we got enough cash for a period of time. And so, Matt, what if someone says, I've got some cash, is it time to get in? I know really it comes down to the particular situation, because every situation is different, but got some cash to invest. Should I invest?
Definitely, we should buy oil contracts. Sorry.
All out, right?
All out, yeah. No, yeah, that's a great question. I would say yes. I think you have to go to a long-term approach. If the money is there for long term, then yeah, let's get that money to work wisely. And wisely would in my opinion be, let's begin to dollar cost average the money, or at least have the discussion, should we dollar cost average that money in, which essentially says we're going to buy in on a systematic basis, emotionless, timingless. We're just systematically putting money into what that long-term allocation should look like. And we'll buy in over 6 months, 8 months, something along those lines, that basically says we're buying in at all different price points. We don't know if the market's going to go up or down. So we just want to mitigate some risk, and that's the way to do it. But you don't necessarily want to leave the money just sitting there. You could, but again, if you're saying, hey, I want to get this money to work, that would be the approach that we would like to have that discussion on.
Yeah.
That would be my thought.
Good. Well, hey, we got time for one more question, and then we'll kind of bring this around. But the question is, the stock market seems pretty optimistic right now, which we might want to comment on that. It feels like a lot of folks feel it's optimistic, probably a lot due to we haven't had a lot of volatility over the last couple of weeks. And with so many unknowns and layers in the economy, and a hope of a vaccine will be created, which may never happen, that's a possibility, and the possible shift of bringing back manufacturing from China, should portfolios be weighted more in the U.S., not in the international equities? I think it's a really good question.
I would say yes. I think it should, at least for the short term. And I think our portfolios are already positioned overweighting towards U.S. versus international. So I think we've not that we've already kind of forward thought that, but I think we've been there for a little while that we need to be. So, but we also don't want to bank on the fact that we are a globalized world and companies are globalized. And so if the U.S. is bringing in about 20 to 23% GDP globally, you don't want to put all of your money in the U.S. I mean, there's definitely money to be made elsewhere, but in the short term, we definitely think that the U.S. is probably a little bit more positioned to handle this storm.
And Matt,
go ahead, Matt. Go ahead, Beth.
I'm sorry, large cap, small cap, and mid cap too, all aspects of the U.S. markets, not just because we know we looked at this a couple of weeks ago, historically coming out of a downward trend, the sectors that generally respond faster to that would be the smaller and mid caps, right? So you would support not just big caps U.S., but all aspects of it?
Oh, I would.
Yeah. And it's timely because, we have our firm investment committee meeting coming up in a little over a week. And so I think it's going to be a good time for that as we continue to monitor and talk about kind of where we're at. The one thing I wanted to address before we move on is the optimistic side. So, it seems like the markets are optimistic. And again, I just encourage everyone, and anyone on the panel can comment as well. But I mentioned this quote about the markets are divorced from reality on what's happening on Main Street. So volatility, we don't think is over. So we're not saying that it's over. Hopefully we've tested the lows that happened back in March, but there's still a lot to go. And a couple weeks in the market and where we're at can provide that optimism, but we also want to make sure that it's probably not over on a volatility perspective, wouldn't you say? Would be it for anyone.
Yeah, I agree. I mean, the VIX has come down. Beth brought that up last week. We're seeing a current trading range between 20 and 24,000 on the Dow. We got to a low of 18. So I think another week or two we'll have a pretty good indication what the floor and the ceiling are. But yeah, some volatility's come off the table, and I think that we're going to have a trading range here over the next couple of weeks that's going to be more predictable and more reliable.
Yeah. Good. All right. Well, let's talk about kind of our takeaways for today, and so that we can kind of bring this for a close. So first one, oil and making sense of it. So hopefully we've talked it through, kind of breaking it down as to what it meant. Oil-wise, certainly at the pumps, it's great. Although I've had some comments this week that, well, yeah, it's great at the pumps, but I'm not going anywhere. So I think, Matt, you commented you got to just get out of your house, right, and fill up your tank.
Exactly.
So, any last thoughts on that?
Nothing that I don't think we've already covered. I think the biggest thing is people have reached out to talk about how can I get into oil? Is that something that can be some opportunity for me because I've got some cash? So I'm saying, hey, maybe I could buy something. We'd love to have that discussion. I think what you buy in oil has to be smart about what you're getting into. And so, again, I don't want to get into specifics individually of what holdings, those types of things. But if oil is something that interests you, we could have that discussion. But I do think that we'll see some volatility there until people get back to work. But I don't know if there's much else that for most people it's influencing them other than cheap prices at the pump.
Yeah, good. The second takeaway is when and how. How is the big question. When and how is the big question, and really around that was when is this thing going to kind of subside and we're going to start to see some market. It won't be a turnaround, but that is a big question. And so kind of how we've thought about it is, we were able to flip a switch and turn the economy off, but to get it back up and ramped up, it's going to be like a dimmer switch. It's going to be a slow turn the dimmer, and slowly the lights come back up. And so we still, in all of the economists and firms we follow, there's still a ton of unknown, isn't there?
Yeah, I think it's an ongoing situation of more information to come, and somebody isn't sitting with that information and refusing to share it. It's just we don't know yet. I think it's going to be interesting to see what happens over the next couple of weeks. We've got what is assumed to be a 14-day incubation period. So I think watching some of these states that are opening today or beginning to open the door a little bit and getting people back to work, it'll be really interesting to watch over the next 2 to 3 weeks to see how that works. And with regard to the disease and infections, that will encourage more opening, to Erik's point, dialing it up a little bit at a time to see how it goes. We just don't know yet. There's too many unknowns. So, when and how is the big question, and there just isn't an answer for that quite yet. We've got to live through it and see where it takes us.
Yep. Good. And then cash, be patient. So Matt, maybe you want to take that one, and then we'll close it out for today.
Yeah, I think be patient. If you're looking for things to do with your cash, be cautious on the teaser rates out there. The 10-year Treasury is trading at 63 basis points, which is 0.63%. So if you're seeing teaser rates for CDs at 2%, you have to kind of scratch your head and say, well, how are they getting 2% when the 10-year Treasury is paying 0.63? So, don't get locked into a product that is not going to behoove you long term. And, those are just things that we're saying, hey, pay attention to. If it's too good to be true, probably is. Quick phone call or email to us, and we can help walk you through that. And Bill, I think you had a comment you were going to say on that. Maybe not. I thought you did.
No, no, I'm good. I'm good. I think patience is a virtue here, and there's going to be more opportunities as we test lows again. So don't worry if you got a little extra cash, it might be just fine.
Good. All right. Well, Beth, Matt, Bill, thank you very much. And thank you for all that have attended. Thanks that's followed us on the phone or followed us on Facebook. We appreciate it. We will be doing this at the same time next week, 3 o'clock. And share the link. Let others join us. Until then, I hope you're healthy and be safe.